And welcome back to the Lance Roberts Podcast. I'm your host, Lance Roberts. And of course, get all of our podcasts every day at realinvestmentadvice.com. Just click on the podcast tab right there at the top of the window, or simply go to our YouTube channel at Lance Roberts Show. And you can get the interview we're doing now with Kevin Smith, who's the owner and CEO of Crescat Capital, along with all of our recent interviews that we've had. They're all there for your consumption pleasure. Kevin, just for the break, we were talking about the issue with China. Their debt issue, of course, is that they've been for a decade now running a massive debit balance or credit balance in their economy, massive amounts of debt being put in the system, building entire cities that nobody lives in, and a whole variety of issues. But this debt-induced economic growth that we saw there has finally started to come to the end of its inevitable cycle. But we flip back here to the United States, and we look at a Fed that has inflated their balance sheet to over $4 trillion. They're now trying to figure out how to get out of that situation. At the same time, they're raising interest rates. The 10-year Treasury rate's coming up. And of course, that's coming up at a time that we have corporations that have issued an immense amount of debt at low interest rates to fund things like share buybacks and dividend issuances rather than making productive long-term investments. Households have re-leveraged themselves to the hilt in terms of credit card debt, student loan debt, et cetera. All this very sensitive to rising interest rates. So do we have a debt problem here in the United States that is about to come undone once again, another financial crisis type situation?
Well, I think there's clearly a debt problem in the U.S. Corporate leverage is at record levels. We just gave a tax cut that is going to increase the deficit by something like $1.5 trillion next year, and if we go into a recession, it's going to be something much more than that. And corporate leverage is a problem. Junk bond yields are at record low spreads, and we see that as an opportunity too on the short side of the market today that we're positioned for, along with being short equities that are at record overvaluation in the U.S. Only a month ago across 8 different dimensions that we measure, from things like free cash flow to enterprise value, median price to sales, market cap to GDP, every possible metric that you can imagine. PE being the only one that forward PE that doesn't really necessarily register, but when you do the margin adjusted and cyclically adjusted PE ratios, it's over 40 times, and it's truly historic multiples here. So when you have historic multiples on top of historic leverage, it's really a formula that could turn into something bad.
Well, and again, one of the things that we've heard about and have had a lot of conversation about, Kevin, is that the bond bull market of the last 30 years has now ended. Rates have nowhere to go but up. But yet, if we go back historically and look at interest rates, inflation, and economic growth, there's a very close correlation between the direction and trend of growth versus inflation and interest rates. And it makes sense, as if interest rates, if economic growth is strong, then corporations and investors or individuals are making more money. They can afford to pay higher rates. So, and you get some inflationary pressures because of consumption. So not surprising that interest rates, start to come up. However, when we kind of look at the landscape today, wage growth, nominal wage growth has picked up. Inflation-adjusted wage growth, not so much. And really, with many investors or many individuals in this country, 80% of Americans really kind of living hand to mouth. We've seen the statistics of 80% of families can't come up with $500 for an emergency. Just how far can interest rates move before you trip up a decline in consumption, which leads to a recession?
Sure, that's certainly one of the problems that we're seeing too, and we wrote a paper about it that we called the Hamstrung Fed, which really points to the situation of the Fed being late cycle and raising interest rates. However, we are still at a place when it comes to the natural rate of interest and things like the Phillips curve and where the Fed actually has not raised rates enough, according to Taylor rule measures and things like that, that would cause it to be able to stop rising inflationary pressures. At the same time, they've already risen rates too much to not prevent asset bubbles globally from bursting. And so the Fed is truly between a rock and a hard place. We have these late cycle rising wage inflationary pressures, other inflationary pressures from deglobalization, rising populism and nationalism and trade wars and supply chain disruptions. We have both these late cycle inflationary measures as well as some potentially stagflationary inflationary pressures that could come into play. When we looked at a multi-factor model of interest rates and where the Fed should be, kind of like a Taylor rule model, and it actually points to periods like the early 1970s as being a much more comparable period to where we are today. Then I know a lot of people are still very concerned about the potential for deflation or a disinflationary bursting of asset bubbles, and certainly we could get some of that, but central banks have really proven that they can revert to QE and drop interest rates. The Fed at least has raised interest rates to a point where they can stop dropping them again. That when we get the next whiff of a financial crisis, and the central banks will ramp up the QE again, we could see a real 73, 74 type of a stagflationary bear market where inflation really takes off.
Well, is it possible? And I guess this is the unknown question, right? In the case of the last round, it was a $4.5 trillion question. How much are we talking about for the Fed to come in and do QE? And this is something I want to pick up on the other side of the break. Is that how much effectiveness will the Fed have during the next financial crisis? They've raised interest rates from basically 0 to a little bit more than 2% now, not coming down from 4. You're now going to come down from 2, maybe 2.5, possibly 3. And how much further can you expand your balance sheet, and just how effective will that be in terms of stemming off potentially a bigger recessionary drag than some people may expect? We'll come back with Kevin Smith from Crescat Capital right after the break. Don't go away.
Got a question for Lance later? Ask now at realinvestmentadvice.com.